Everyone thinks they know who controls the price of money.
They'll say central banks. Interest rates.
A few people in suits, sitting in a room, deciding the fate of the economy.
That answer feels comforting.
It's also incomplete.
Because if money were really controlled by a single institution, the world wouldn't keep breaking in the same ways, again and again.
And yet, it does.
Right now, the price of money is squeezing households, governments, and markets all at once. Mortgages, credit cards, national debt.
Everything feels tighter.
More expensive.
Less forgiving.
So the real question isn't who sets interest rates.
It's who actually controls the system that makes interest rates matter.
To understand that, we need to rewind.
For most of modern history, money wasn't something you borrowed easily. Credit was scarce. Risk was personal.
If a lender made a bad decision, they paid for it.
That changed quietly in the 20th century.
Governments wanted growth.
Banks wanted scale. Economies wanted speed. So a new system emerged.
A system where money could be created through lending itself.
When a bank issues a loan, it doesn't hand out existing money. It creates new money. A deposit appears. Debt appears. The system expands.
This is the core mechanism almost no one talks about.
Most of the money in the economy is not printed by governments.
It's created by private banks through credit. Central banks don't directly control this process. They influence it. They set short-term rates. They provide liquidity. They act as backstops. But the decision to create money happens every time a loan is approved. and that decision is driven by incentives. Banks don't ask, "Is this good for the economy?" They ask, "Is this profitable, and is it safe enough?" Safety doesn't mean stability. It means collateral.
This is where the real control begins.
Money flows not to where it's most productive, but to where it feels safest.
Real estate, financial assets, government-backed lending.
Over time, this inflates asset prices faster than wages.
Housing rises. Stocks rise. Debt rises.
And suddenly, the price of money isn't just an interest rate.
It's access.
Who gets cheap credit?
Who gets denied?
Who must borrow to survive?
Who can borrow to accumulate? Central banks can raise rates to slow things down. And they do.
But here's the uncomfortable math.
When rates rise, debt doesn't disappear.
It becomes heavier.
Governments owe trillions. Corporations refinance constantly.
Households live on monthly payments.
Higher rates don't just slow spending, they shift power.
Debtors become more fragile.
Creditors become more influential.
And the largest creditors in the system are not households.
They are institutions. Pension funds.
Sovereign wealth funds.
Banks.
Funds that hold government debt itself. So when policymakers say they're fighting inflation,
What they're really doing is navigating a balance between pain and collapse.
Raise rates too little, and prices run away. Raise them too much, and debt breaks things. This is why interest rate decisions feel hesitant.